Everyone, this is Shobha Rani R. Today I am going to take up the topic reconciliation of cost and financial accounts. There are two methods of keeping cost accounts by double entry system: integrated accounts and non-integrated accounts. Under integrated accounts, the cost and financial accounts are integrated into one set of books and only one common profit and loss account is prepared. In such a case, the need for reconciliation does not arise. In non-integral accounting, the cost and financial accounts are separately maintained in two different sets of books. Two profit and loss accounts will be prepared, one for costing books and the other for financial books. The profit or loss shown by costing books may not agree with that shown by financial books. Therefore, it becomes necessary that the profit or loss shown by the two sets of account is reconciled. This means the need for reconciliation arises only in non-integral system of accounts. The need for reconciliation arises due to the following reasons. Reconciliation reveals the reason for difference in profit or loss between cost and financial accounts. It also helps in checking the arithmetic accuracy of the costing data. The various reasons which create the difference between cost and financial profit or loss shown by the two sets of books may be listed under the following heads: items shown only in financial accounts, items shown only in cost accounts, absorption of overheads, method of stock valuation, abnormal loss and gains. The item shown only in financial accounts. Some items of income and expenses which are included only in financial accounts but are not shown in cost accounts and vice versa. The following items are shown in financial accounts but not in cost accounts. The financial incomes like profit on sale of fixed asset, interest received on investment, dividend received on investments, rent, brokerage and commission received, premium issues on shares, transfer fees received. Some financial expenditures shown only in financial accounts but not shown in cost accounts. They are loss on sale of fixed assets, interest paid, discount paid, dividend paid, loss due to scrapping of plant and machineries, penalties and fines, expenses of shares and transfer fees, preliminary expenses written off, etc. There are some items which are recorded only in cost accounts but are not included in financial accounts, like notional interest on capital, notional rent of premises owned, salary to proprietor, etc. are not recorded in financial accounts because the amount is not actually spent or paid. These expenses reduces the profit in cost accounts. Absorption of overheads. In financial accounts, actual amount of expenses paid are recorded, while in cost accounts, overheads are charged at predetermined rates. If overhead charged are not equal to the amount of overhead incurred, the under or over absorption of overheads leads to difference in profits of two accounts. The methods of stock valuation. The term stock refers to opening or closing stock of raw materials, work in progress and finished goods. In financial accounts, stocks are valued at cost price or market price, whichever is lower. In cost accounts, stock of raw materials can be valued on the basis of FIFO, LIFO and simple average methods. Work in progress may be valued at prime cost or works cost. Finished goods are generally valued on the basis of cost of production. Thus, the adoption of different method of valuation of stocks leads to difference in profits of two sets of accounts. Abnormal losses and gains. The difference items of abnormal wastages, losses or gains which are included in financial accounts but are not recorded in cost accounts. Thus, the figures of abnormal losses and gains may affect the results in financial accounts alone. Reconciliation statement. The constant financial accounts are reconciled by preparing a reconciliation statement or a memorandum of reconciliation account. The following procedure is recommended for preparing a reconciliation statement. So the first, ascertain the profits of difference between cost accounts and financial accounts. Then start with the profit as per cost accounts. Later, regarding the items of expenses and losses, add items overcharged in cost accounts and deduct the items undercharged in cost accounts. Regarding the items of incomes and gains, add items under-recorded or not recorded in cost accounts, deduct items over-recorded in cost accounts. Regarding valuation of stock, the opening stock, add amount of overvaluation in cost accounts, deduct amount of undervaluation in cost accounts. Closing stock, add amount of undervaluation in cost accounts, deduct amount of overvaluation in cost accounts. After making all the above additions and deductions in costing profit, the resulting figure shall be the profit as per financial books. Memorandum of reconciliation account. This is an alternative to reconciliation statement. Reconciliation can also be done by preparing a memorandum reconciliation account. This account is a memorandum account only and does not form part of the double entry. When reconciliation is attempted through memorandum reconciliation account, the profit to be taken as base profit is shown like opening balance of this account. All the items of differences is required to be deducted are debited and those to be added are credited to this account. The balancing figure of this account is profit shown by the other set of accounts. The specimen form of memorandum reconciliation account is given as follows. Reconciliation of cost and financial account is necessary for the following reasons. To ensure the arithmetical accuracy of both the set of accounts, for effective cost ascertainment and cost control, to identify the reasons for different results of accounts, to evaluate the reasons for variations, for effective internal control, and to enable the smooth cooperation and coordination between the activities of cost and financial accounting departments, to ensure the standardization of policies relating to stock valuation, the depreciation and absorption of overheads. Thank you.